We've already heard a bit about private credit, and that is a huge market in its own right that within just a few years they've graduated from financing small and medium enterprises to competing directly with the high yield and the leveraged loan market for the much larger issuers that do have access to the public high yield bond market, to the point where, particularly because a lot of that financing has been concentrated at the lower quality end, we see a historically low percentage of CCC debt within the high yield index. So that's just one visible effect that we're seeing of it. But I wonder if maybe starting with Clint, we could talk about what other effects you're seeing on the high yield market or also leveraged loan market, if the case may be, of this tremendous growth in the last few years of private credit.
Yeah, I've been involved in the high yield market for many years, and initially, there wasn't a lot of competition. If you were sub-investment grade borrower, you had to go around, do a road show, really court high yield investors to lend money. And then as the CLO business grew and the broadly syndicated loan market grew, the bankers got very adept at making those two, running parallel processes and competing away spread by having the two asset classes compete for funding. What private debt has done is introduced yet another competitive source of financing for companies, and as LPs have prioritized, rightly or wrongly, a little bit of incremental spread for a lot less liquidity, what you have is a situation that it's driven covenants to more competitive levels, not in the direction of that the lender would like to see, but definitely favoring the borrower. It's also, to your point, had a meaningful skew of the composition of the market. I was actually looking at this in preparation for this meeting. If you go back 20 years, we go to the end of 2006, the high yield market at that time was about 15% triple Cs. It was about 40%. A little less, was 38% double Bs, and the balance and the bulk of the asset class was single B rated. Today, if you look at the index as of last night, it's about 60% double Bs, only 8% triple Cs, and the balance being the single Bs. So you can see the noticeable shift as lower rated credits who are willing to pay up in spread or have to pay up in spread have really been absorbed by the private debt markets. And I think another stat that I think is remarkable to read, since 2024, there's been about 60-70 billion of public to private refinancing. So this is where initially the borrower borrowed in the public markets, refinance in the private debt markets. 90% of that paper has been B minus or lower rated credit. So I think the effect that it's had is it's really changed the skew and the quality profile of the markets. And if you look at, if you go back in history, the Drexel-Burnham days, high yield was a frontier asset class. If you go into maybe leading up to the financial crisis, the broadly syndicated loan market was maybe a frontier asset class with lower credit quality. And today, to me, the asset class that's absorbing some of the lower quality credits that come to market is definitely private credit.